Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the economy in Turkey because things are starting to heat up again. If you've been following the channel, you'll know that the situation had been improving. We'd seen inflation coming down, and interest rates have also started coming down from a high of 50% that was seen at the back end of 2024. But unfortunately, following the recent arrest of the mayor of Istanbul, who's seen as being the main challenger to President Erdogan for the next election, he's now incarcerated and so won't be able to run in the next election as it stands right now. And also the imposition of 10% tariffs on all imports into the USA. We've seen Turkey starting to go into free fall again, and interest rates have risen. Now, if we start off by looking at what's going on with inflation, which has been a persistent problem for Turkey over the past few years, you can see that back in May 2024, inflation had risen to above 75%. That is an incredibly high rate of inflation. That is not sustainable for any economy. You can't continue if prices are going up by 75% every single year. But you can see that over the past 12 months, the situation has improved. And the most recent data for April 25 shows that inflation is now sitting at just under 38%, which in itself is still a very high rate. If I was talking about inflation of 38% in the USA or the UK or Canada or Australia or somewhere like that, that would be a complete collapse of where they are from right now. So this basically would be an emergency in most economies. But when you take account of what's been happening in Turkey, you have to say that 38% is relatively good compared to where it was last year, but it's still not sustainable. You still can't have prices rising by 38%. And just to put that into perspective, this compares the current rate of inflation in Turkey against the rest of the G20, the 20 largest economies in the world. And you can see that there's only one economy that has a worse situation in terms of prices, and that's Argentina, where inflation is currently sitting at over 47%. But when you look at relative terms, Argentina is improving at a faster rate. Last month, its inflation was 56%, it's now down to 47%. If we jump back to the 12-month chart for Turkey, you can see that we've got a bit of a flatline situation. The last 3 months, February, March, and April, inflation has sat at around 38 or 39%. So there is a concern that we're not going to see that continuation of inflation coming down to a more manageable target of maybe 10% or 15%, which is still very high for most economies, but would be a massive improvement from Turkey's perspective. And if we have a look at how the current rate of inflation compares with the rest of the world, you can see that there are only 6 countries that have worse inflation. Venezuela, where it's over 100%, but the last data that we had out of Venezuela was actually February, so that's not 100% reliable. South Sudan, the last time we had data from them was October 24, and that showed 113% inflation. Zimbabwe has provided recent data, and it's showing inflation of 86%, sorry. Argentina, we've just discussed, and Burundi is the only other country with a higher rate of inflation than Turkey at just under 40%. So this really puts into perspective just how serious the situation is in Turkey. When you're in the top 6 or 7 in the world from an inflation point of view, that's not really a group that you want to be part of. Now, I mentioned interest rates at the start of today's video. And if you've been following the channel, you'll know that historically, President Erdogan was operating a contrarian policy. So, in traditional terms, if you've got high inflation, you would increase interest rates to make borrowing more expensive and also to encourage people to save money. Because if you're getting paid a high rate of interest in the bank, then theoretically, you might want to put your money in the bank and take that rate of interest. But rather than doing that, when inflation rose in Turkey around 3 or 4 years ago, President Erdogan decided to reduce interest rates. And what happened was that sent inflation sky high. And he's now changed that policy. You can see here, which shows the movement in interest rates over the past 3 years, that during 2023, interest rates started to go up. And they rose from a low of around 8% to a high of 50% by May 2024. And obviously 50% in interest rates is off the scale. If you were borrowing money If you borrowed $100 off somebody and they said, that's fine, the interest rate is 50%, you have to pay me $50 interest every single year that the loan's outstanding, you never would take that deal. That is a crazy deal to sign up to. In fact, I don't think loan sharks or the mafia charge 50% interest. Maybe the mafia does, I'm not quite sure. But 50% interest basically means that you would not borrow unless you absolutely had to. So this really reduced the amount of demand for debt, therefore should have reduced spending and therefore should bring prices down. And what we've seen is that that policy has been working. We just had a look at what's been going on with inflation. It's come down from more than 75% to less than 40%. And as a result of that success, interest rates started to reduce again. And in December, we saw the rate coming down from 50%, and that's come down in two further chunks since then and was sitting at 42.5%. However, in the middle of April, interest rates were increased to 46%. And that sort of goes against the policy of what we're talking about with reducing inflation. You would have expected interest rates to carry on going down. But as a result of the civil unrest that was seen in Turkey and also the tariffs that were introduced by Donald Trump, it was decided that interest rates should be raised again. And one of the reasons for that is because of what's been happening with the Turkish Lira. This chart shows the movement in the value of the Turkish Lira, the exchange rate between the US dollar and the Lira over the last 12 months. And you can see that 12 months ago, one US dollar was trading for around 32 Lira. Today, it's trading for just under 39. So that represents a fall in value of the Lira of more than 22% in the last 12 months. And if we expand the scale of this chart to show what's been happening over the past 5 years, you can see the situation is really quite bad. 5 years ago, one US dollar was trading for around 7 Turkish lira. Today it's at 39, which represents a fall in value of more than 5 times over that 5-year period. So what that means is that if you were buying something in Turkey that was costing $1, 5 years ago, that would cost you 7 Turkish lira. Today, it would cost you 39. So that would mean that in order to keep pace with the price of those imports, you'd have to have seen a 5 times increase in your salary over that 5-year period. So that basically means you'd have to get almost 100% increase every single year. And obviously, nobody is being paid that sort of money in Turkey. And this represents a serious issue for Turkey because it's still a net importer. It's importing more than it exports, and it's importing expensive things like oil and gas and food. And so for the people of Turkey, life has become quite difficult. And we have a look at what's been happening with food inflation. We can see that over the past 12 months, the trend has been similar to what we just looked at for general inflation. In May 24, food inflation was running at around 70%. Today, it's down to around 36%. So we've seen it come down by almost 50%. It's halved. But 36% increase in food prices year on year means that in order to maintain the status quo, you would need to have a 36% increase in your wages over that last 12 months. And Turkish people haven't been seeing that. They haven't been seeing anything like 30% increases in their wages. And if we look at how this compares to the rest of the world, you can see that for the G20, Turkey has the second highest rate of food price increases. It's only Argentina that has a higher rate at 41%. And the next highest is Russia, where food prices have risen year on year by almost 12.5%. And then every other member of the G20 is in single figures. Now, one of the issues that Turkey is facing is that it's a manufacturing country. It's making lots of things which are exported all around the world. So the price of the products that Turkey is producing is really critical to make sure that it remains competitive and it will continue winning contracts and business and bringing in revenue for the state. And this chart shows the movement in producer prices, otherwise known as factory gate prices, so the price of products once they're leaving the factories in Turkey over the past 12 months. And you can see that 12 months ago in May 24, producer prices were increasing by around 60%. And obviously that's a major problem. If your costs and prices are constantly going up, it's going to mean at some point you might start losing business if you become less competitive with other countries, because Turkey is competing with other low-cost labour countries. But over the last 12 months, we've seen a reduction in the increase in producer prices, which is obviously a positive. However, in April 25, the year on year movement in producer prices was still 22.5%, which is a big increase. And that's putting a question mark as to whether or not Turkey will remain competitive. And if we see how that compares to the rest of the G20, you can see that only Argentina has a faster rate of increase in producer prices. Its producer prices went up by 28% in March 25. So Turkey is rising at a much quicker rate than everybody else. Every other member of the G20 is at less than 10%. They're all in single figures. And you can see down the bottom here, we've actually got some countries where producer prices are falling. And if you follow the channel, you'll know that's a major problem for China at the moment. And if we have a look at how that increase in producer prices compares to the rest of the world, you can see that Turkey is in the top 5. There's only Ukraine, where producer prices have gone up by 52% year on year. And obviously, Ukraine's got major problems at the moment with the war against Russia. Argentina, we just discussed. Angola, where prices have risen by about 26%. Ghana, 24%. And then Turkey comes in at number 5. And this represents a problem for Turkey because if it's becoming more expensive, then that might mean that it loses some of its contracts. Now, obviously, when we're talking about international prices, there is a trade off against what's going on with the value of the lira. And as we discussed, over the last 12 months, the value of the lira has fallen by around 22%, which is exactly where producer prices have gone to. So, on a net basis, those exports are probably costing around about the same for the buyers internationally than they were this time last year. But what Turkey doesn't want to do is constantly see the value of its currency eroded every single year to benefit from this increase in producer prices, because net it's going to cost Turkey more, because as the value of the lira goes down, it means that all of its imports are becoming more expensive. And as I said, Turkey is a net importer. It's buying in lots of things from overseas, and that's putting further pressure onto the economy and onto the lira, and this becomes a vicious circle. And as we've discussed previously, there is a high level of dollarization in Turkey. The people of Turkey feel more comfortable with the euro or the US dollar rather than holding their life savings in Turkish lira. And that then becomes really difficult for the central bank to control if a lot of the people are not actually using the lira, because it means that interest rates are actually not affecting people. When you increase or decrease interest rates, if everybody's working in US dollars and euros, then it doesn't really have any impact on them. And then you lose control of your economy. And at some point, that your currency could become redundant. So what's the summary and conclusion today? Well, I wanted to post this video because we've been following what's been happening with Turkey for a long period of time now. And as we've seen in today's video, inflation is continuing to go in the right direction. We're seeing inflation going down, and this has been a long-standing issue from Turkey's point of view. 12 months ago, it was sitting at around 75%. Today, it's sitting at less than 40%. So at face value, that looks like a positive trend. However, inflation looks to be sticking at around 40%. It's been sitting there for the past few months, and that's going to prove a problem if Turkey can't keep bringing it down, because 40% inflation is not sustainable. That means that people in Turkey need to be paid at least 40% pay increases just to maintain their purchasing power. That's not happening. So the people in Turkey are feeling the pinch. They've got less disposable income every single month to be spending on food and other items. So that's an issue in terms of growing its own economy, trying to build itself back up through its own consumer demand. But one of the other things that we've seen in today's video is that interest rates are now going up again. And that's going to depress the demand for debt and borrowing. And that means that we'll probably see a reduction in demand, which will lead to a reduction in prices, which is good from an inflation point of view. But it also means it will be a reduction in revenue and earnings and tax for all of the companies in Turkey. So obviously that is a bad thing. And overall, I think that pull down factor of a reduced economy, a slowdown in GDP, is probably going to weigh heavier on Turkey than a reduction in inflation. But what we've also seen in today's video is that the value of the lira is continuing to tumble. It's now hit a new record low. It seems to hit a new record low every single month at the moment. And that's bad news for Turkey overall, because what that means is that the people in Turkey are losing faith in the currency. A 20% fall year on year in the value of your currency means that if you are holding all of your assets in lira, if you had your life savings, let's say you had $100,000 equivalent in lira in the bank, when it's falling by 20% every single year, that means that the purchasing power of that $100,000 has gone down by 20%. So effectively, your 100,000 has dropped to around 80,000 in terms of what you can exchange that money for. Because if you're buying things that are imported, or you want to go on holiday, let's say you go overseas and you want to spend some money, the purchasing power is going down all the time. So rather than holding their savings and money in lira, a lot of the people have decided to hold it in US dollars and euros, and that maintains its value over the long term. It's seen as a little bit like gold, which is also very popular in Turkey. So, what this means for the Turkish economy and the Turkish central bank is that as more and more people migrate away from using the lira and prefer to use other currencies, they're losing control of the economy, because by moving interest rates up and down, what you're trying to do is encourage people to either spend and borrow more or to save and reduce their spending. But if nobody's actually using your currency, it doesn't really matter what you're doing with interest rates, because it has no impact on them. They're not interested in borrowing in lira, they're not interested in saving in lira. And so the central bank becomes marginalized and you lose control of all of the key aspects of the economy. And that's what's happening in Turkey now. So whilst inflation is coming down, which is a positive, it isn't coming down rapidly enough to encourage the people of Turkey to start using the lira wholesale. People who are employed by the government and who are in control of things that they don't really have any say over, then they have to use the lira. If you're being paid by the state, you will be paid in lira and you'll keep your money in lira. But for everybody else who's got the choice, they're avoiding the lira. And this is going to be a long-term issue from Turkey's point of view, because the longer this goes on, the more difficult it will be to regain control and to bring everything back in order. But the other thing that we talked about in today's video is that Turkey, at its heart, is a manufacturing nation. It's got low labour costs and therefore it's benefited from global outsourcing. But one of the problems that it's now facing is that because of Donald Trump's reciprocal tariffs, and that's his phrase, not mine. I know some people get very upset when I say reciprocal tariffs, but please don't send me a message about it. I'm just using it as a term of reference. But because he's now applied a 10% tariff on all imports from Turkey, that's going to mean that they're going to be more expensive. And so it's likely that we'll see a reduction in demand for those exports from Turkey in the USA. And so Turkish businesses will suffer as a result of that. They'll sell less product, therefore earn less revenue, pay less tax, therefore GDP will be impacted. And as a result of those tariffs, we've now seen interest rates being increased again, partly as a result of also the arrest of the mayor of Istanbul. And we're now seeing producer prices rising by around 22%. And all of this is going to mean that Turkey is going to struggle to compete globally. It's going to struggle to earn as much money from the USA as it has been doing historically. And as a manufacturing nation, it needs its manufacturing businesses to be expanding, not contracting, in order to try to grow the economy and make things better for Turkey overall. So the tariffs are going to represent a challenge for Turkey. And I'm sure there's negotiations going on at the moment. But as we saw from the first deal that was announced with the UK came out with a 10% tariff compared to the 10% that had been offered by the USA. So if Turkey agrees the same deal, if it agrees a 10% tariff, then that's going to impact on Turkish businesses, Turkish revenue, and Turkish GDP. So the overall summary of today's video is that whilst we're seeing an improving trend in inflation in Turkey, there are other issues that are now affecting the economy. We're seeing a continued fall in the value of the lira. That's making imports more expensive. It's making food more expensive for people. The people of Turkey are struggling in terms of being able to maintain their spending power. And overall, Turkey is still in a precarious state. And the imposition of the 10% tariffs by the USA, which is its second biggest export market, in 2024, it exported around $15 billion worth of goods, around 6% of Turkey's exports. The imposition of those new tariffs is going to affect Turkey's exports to the USA probably going to reduce its revenue and profitability, and therefore represents a further challenge for Turkey going forward. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and thank you so much to everyone that's supporting me. If you've bought me a coffee, thank you for that. If you've sent me a YouTube super thanks, really appreciate it. And if you're a long-term supporter, either through Patreon or YouTube membership or Buy Me a Coffee membership, really appreciate that support. It helps to keep me going, keeps me motivated, and here's something to put a smile on your face.